Welcome to video T3D on markets and taxes. This topic is a bit esoteric, but has real implications for tax planning that play out in reality every day. Even though we have not spent a great deal of time unpacking the Internal Revenue Code, and don't worry, we'll get there, you probably have this vision of a giant softback book with thousands of pages that prescribe tax rules for just about every transaction under the sun. And you'd be correct. That is almost exactly what the Internal Revenue Code is, a big book of rules that says who pays tax, how much tax, and when. What the code does very little of, however, is provide explanation on how that tax burden is allocated to taxpayers. Go back a few videos and we discussed how a tax credit for a fuel-efficient car, though paid to the consumer, actually is passed on to the manufacturer through price, or how the hotel tax in Florida can be passed from the tourist to the hotel, or how the lack of a sales tax in New Hampshire can affect the flow of business in a geographic area. Once we realize that taxes can affect people's behavior, we should plan accordingly, right? Just like Tingsboro might have with a new toll road, or a county in Florida might with a tax rate reduction. Armed with this knowledge, we can use taxes to our advantage. That's right, I said it. Let's look at an example. In this case, tax-savvy Mrs. O wishes to purchase land from DC Company, and it's almost year-end. DC bought the land 6 years ago for $580,000. According to a recent appraisal, the land is worth $900,000. The current tax rate on the gain on the sale is 30%. But there's a good chance the tax rate will increase to 40% next year. DC has a 5% discount rate. Mrs. O recognizes the effect of taxes on cash flows and comes up with a great idea. Why should she offer market value when, if she agrees to close this deal by year end, she might be able to offer less because we think tax rates are going up next year? And why on earth should DC Company accept an offer below market value? If we examine the sale as if sold this year, and thus DC captures the lower tax rate, it sells for Mrs. O's offer of $860,000. DC generates a gain on the sale of the land of $280,000 and pays taxes of $84,000 and ends up with $776,000 in pocket. If DC holds out until next year, hoping to get an offer for market value, the proceeds on the sale will be $900,000, but the tax on the new gain will be $128,000, leaving DC with only $735,000 or so. It is clearly in DC's best interest to accept option 1 over option 2, but DC is also tax savvy. If we examine the sale as if sold this year, and thus DC captures the lower tax rate, it sells for Mrs. O's offer of $860,000. DC recognizes that there must be an equilibrium price at which the lower price equals the cash flows if sold later for the greater amount. DC Company has an SDSU graduate on staff, and they are given the problem of finding that equilibrium price. No problem, they say. I learned that in my accounting class. And simply use some simple algebra to determine that the equilibrium price is about $801,000, and that Mrs. O has overplayed her hand. She should have offered only $801,000. Scenarios such as this play out frequently in the world of corporate mergers and acquisitions, where actions by one party can also affect the taxes of the counterpart. One of the most famous is a transaction between Seagram's and DuPont, where because of a court case, all the backroom negotiations were made public, revealing how tax played a major role in the price set for the stock. I encourage you to Google the 1995 issue and take a look. In perhaps a way that more closely affects those of us not expected to enter the world of corporate takeovers, is how this same tax plays out in the employment market. Unless you are going to be a sole contributor your entire life, you are likely either to be or have employees, and understanding this relationship will be helpful. Let's start by providing some background on employer-provided health care. In the U.S., it is quite common for an employer to provide health insurance to its employees as a fringe benefit, and typically at a lower cost than could be negotiated individually. Some employers help employees by paying a part or all of the premiums on the health insurance plan. So between the offering of a negotiated plan and paying for part of it, most employees take the benefit unless covered by a spouse or parent. To encourage employers to participate in this way, the tax code provides that an employer can take a tax deduction for the portion of healthcare insurance premiums the employer pays. And here is the real kicker. The employee does not have to include that amount in their income. You can file this generally under the topic of non-taxable fringe benefits, of which healthcare is but one. Okay, let's apply these rules in an example, and don't worry, I am going somewhere with this. Bill Getz is going to be hired by Minisoft, and his services are thought to be worth $100,000 per year. Bill and Minisoft have a 30% tax rate, and we are going to ignore any employment taxes to make our lives simple. Bill wants and needs healthcare insurance. Assume he's not eligible for Obamacare, if that even exists at the time you're watching this. And he expects that a policy will cost him $10,000 a year. Minisoft is considering two possible offers to Bill. Number one, pay him $100,000 and let him buy his own health care. Number two, pay him $90,000 and pay for his health care. From Minisoft's perspective, it really makes no difference, at least from a financial perspective. Either way, Minisoft incurs deductible business expenses of $100,000, wholly as compensation to Bill, or as $90,000 in compensation and $10,000 in healthcare insurance premiums. Either way, the after-tax cost is $70,000. From Bill's perspective, however, these two options have different outcomes. If Bill is paid the $100,000 as compensation, he pays income tax on the entire $100,000. His after-tax income is $70,000, and then he pays $10,000 in health care, leaving him $60,000. If, on the other hand, Bill accepts the health care package from Minisoft, his compensation is only $90,000, on which he pays tax of $27,000, leaving him with $63,000 after tax. By using the non-taxable fringe benefit, Bill is able to increase his after-tax cash flow by $3,000. Sweet. But like DC Company, Minisoft hired an SDSU business graduate that informed the CFO that before they make that offer to Bill, they should determine exactly how much of that benefit they could keep rather than pay to Bill. Using a little algebra, Minisoft determines that if they offer Bill only $85,714, he would receive the same after-tax benefit as if they offered him a salary of $100,000. Now we're back in the land of negotiation, and which party has no suitable substitutes? If Minisoft is the only business interested in Bill's services, they will control the negotiation. If Bill brings to the table something no other person can, he will dictate the negotiation terms. It's all about elasticities. So far, all of our markets have been arm's length markets. That is, a situation where the buyer and seller are unrelated and negotiating in good faith and are not forcibly compelled to do so. What about when that is not the case? And what about when the markets have hundreds or thousands of participants all setting prices continuously? How do taxes play a role? Let's start with a big marketplace like the bond market. Tom wishes to purchase some municipal bonds in the open market. The market for muni bonds is large and has many players. Like most muni bonds, the interest paid is income tax-free, making these a favorite among high-income earners. Tom knows that a taxable bond with the exact same characteristics pays 5% interest per year. We can compare the after-tax return of these two investments, as shown on the table. The taxable bond pays $50 a year, for which Tom would pay tax of $20, leaving him with $30. The tax-exempt bond also pays $50, but Tom pays no tax and therefore receives $50. Given that the risk and duration and all other measures of comparability between these two bonds are the same, the tax-exempt bond is clearly the superior choice. But guess what? The City of Boston also hired an SDSU business grad, and that person knows there is no such thing as a free lunch, and it is long overdue to take a bite of Tom B's lunch. As a result, this remarkably bright staffer says, hey, why don't we offer our bonds at a slightly lower price than 5%? We'll save some money on interest, and instead we'll build a, new football stadium. The city overwhelmingly agrees, and the Aztec calculates the equilibrium price for the bonds. That is, at what point would Tom be indifferent between a tax-exempt city bond and a taxable bond? That rate is the after-tax rate on the taxable bond, or 3%. Did you see how knowledge of tax permitted the City of Boston to lower its interest rate on its bonds to 3% instead of 5%? When the pre-tax return of an investment is lowered to compensate for a tax advantage, we call that an implicit tax. If Tom buys the taxable bond, he pays an explicit tax. But because of the way the muni bond market operates, Tom still pays a tax. It's just implicit in the pre-tax return. That was lowered from 5% to 3%. And believe me, that is exactly how the municipal bond market operates. Trust me, it's the best. It's huge. Ask anyone. Okay, I'd like to introduce a new player into our muni bond market. His name is Colin. And unlike Tom, he's not making the big bucks. Whereas Tom was in the 40% marginal tax rate, Colin is in the 10% marginal tax rate. Colin catches wind of these great tax-exempt bonds and decides he wants a share of the action. How can you miss with a tax-exempt bond, he wonders. This table presents the returns available to Tom and to Colin if they select either the taxable bond or the tax-exempt bond. As you can see, Tom is indifferent between the two bonds. However, because Colin's tax rate is lower than Tom's, he is actually better off in the taxable bond. As long as the City of Boston can find enough Toms, the Aztec on staff will recommend the lowest rate possible, which is 3%. To the extent the muni bond market has more Collins in it, the city will be forced to push the rate up to compensate bondholders for their risk. As I mentioned before, that is how the muni bond market operates. Trust me, it's the best, it's huge. Ask anyone. That is why low-income taxpayers should avoid the muni bond market. Interest rates are set with high-income taxpayers in mind, Toms, and the Collins of the world could generally do better in taxable bonds. All right, now I'd like to turn our attention to another market that does not always behave as it should. In this situation, we're going to pick on my sister, who happens to be a dentist. She does okay for herself and is in the 40% marginal tax bracket. Her daughter, on the other hand, generates no real income and is in the 10% bracket. The dentist decides to pay her daughter $10,000 to perform a few odd jobs around the office. The dentist actually takes that money and has it invested in her daughter's college fund. By shifting this income from the dentist's business, taxed at 40%, to her daughter, taxed at 10%, the dentist saves $3,000 by shifting the income to a related party. However, because the dentist and her daughter are related parties, this is not an arm's length transaction and is likely to be subject to scrutiny. What services did the daughter perform? What is the market value of those services? What does the dentist pay other people who perform the same or similar services? Think back to the Glaxo Pharma example, where Glaxo US paid Glaxo International for the rights to sell the drug. If that transaction is at arm's length, the IRS has little to argue about. Because it was not arm's length, scrutiny is the expectation. Sadly, that almost brings us to the end of the videos in Module 1. I tried to cover just about everything of importance in the 3 chapters we covered, but be sure and read them on your own. I've provided a summary video that goes over each area. Good luck with the homework and quizzes. Thanks for watching.